Okay, good morning, everyone. Mike and Corey here today on December 17th as we near these holidays. Today I'm going to talk about the United States versus Europe, grades from college versus investing. So that'll be an interesting topic. And then I'll do a comparison to show how companies have done in the United States versus Europe. And then Corey's going to talk about inflation hedges, which we always want to know how to do that. So before I get started, I must remind you this is a financial education presentation. You must do your own due diligence on anything that you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and Corey's alone. So, since I know before I share my screen, there's many parents out there like myself who want their kids to do good in college, high school, whatever. I believe we all want kids with good grades. And I'm sure Corey's one of those young men who has good grades. But when we look at the United States versus Europe, it's a little disturbing that Europe has actually been doing better in grades, but the silver lining is we're still the place to invest. And the question is why? Why would that be? So, anyways, saw
Mike,
this
have
article.
you heard the saying going around, Europe is a museum,
Mhm.
Japan is a nursing home, and they say the United States is a business. That's how we run the
There you
country.
go. Now that we've
You
offended
think?
all the people in Europe and Japan, no, I'm just kidding. And I don't
I
know
don't
what you're
know.
gonna
Maybe.
what are you gonna say China is? I'm not even sure. So
Well, they have one for that. It's a jail. That's what they say in the saying. I
oh
don't
my
know.
gosh. Well, anyways, I saw this article in the Wall Street Journal, and I just the headline picture, just that first picture is telling. So on the left you have the big bully with the United States shirt and a C- report card, and you have the little guy with the map of Europe. It is A plus. And by all means, you would think that if you were going to invest, you want to go where the people are with the best grades. That would be my inkling. But so let's look into this article. It's pretty funny. They say that only 12% of Americans score at the highest level on internationally administered academic tests. I would poke a hole in the statistics to say how many people are taking these things. United States or Americans certainly probably only represent 12% or less of the population when you consider China and India and how many people are there. So maybe 12% isn't that bad. I don't know. But here's where the rubber meets the road. 34% score at the lowest level. So even if we don't have that much of a population, we're knocking out that bottom third. So where Germany is nearly even, and you can see countries like the Scandinavias, Norway and Finland and all them, and Japan, they score much, much higher. So there you go. You got a Japan in there for the nursing home reference. So what does that mean for investing? And I thought this stat here was very telling. Europe has created, in the last 50 years, they've created 14 companies worth more than $10 billion in the last 50 years, worth a total of 400 billion. That's 400 billion. That sounds good. Americans have created 250 companies worth 30 trillion. So when it comes to investing, and I will tell you that overall our models are uh, hugely United States. There's one small position in some aggressive models that we have in India, but we are staying invested in the United States so far. I mean, I'm looking at some ways to expand that a little, but we have to be very, very selective on how we do it because just overall, the United States is a place where you want to own companies. Um, so what happens? What happens from this? So uh, more, new jobs that pay more are created in the United States by these companies that have come out. So you think the Googles and Apples, Microsoft, Nvidia, all these fantastic companies. They do lots of hiring both in the United States and abroad. I mean, there's no doubt that they are international, but just a background on the reason. So Corey, what do you think about that? I'm sure you've met very intelligent people from other countries. Um,
Yeah, absolutely. I think there's a culture in America for putting money to work efficiently and getting a return on capital that just simply isn't emulated commonly throughout the world. And I think there's some, there's some cultural aspect to it. There's some government regulatory aspects to that. You'll hear that in a place like America, some of the most famous and notable people are these billionaires, maybe an Elon Musk or a Jeff Bezos, and they're sometimes culturally celebrated. And that sentiment is not true elsewhere. So,
hmm.
generating value, generating capital appreciation and growth through the form of business isn't celebrated as it is here.
Yeah. So I thought I would show a graph because we want to have real statistics, not just article statistics. So this is a graph of the S&P 500 is the purple line, and the Vanguard All World No US index is the bottom one. So this is a year-to-date graph. You can see the S&P just as a baseline has returned 27%, and the all world, the world without the United States has returned 6%. And if I back this out even further and look at a 5-year graph, which we're almost getting back to pre-COVID, we'll have a 5-year anniversary for COVID. You can see S&P up 88%, all world up 11. So, could this change? Certainly over years, it could change. But until I see this start to change, it's hard to make yourself really invest abroad unless you see something. So, and then last, I just wanted to show, and this comes from J.P. Morgan's Guide to the Markets. And what this shows on the right that I like is this shows the percent of global market capitalization, and that top gray line is the United States. It's up to 67%. You can see in 1987, Japan actually had a higher percentage than the U.S., and they've drug on down to 5%. So, this kind of gives you an example so you can see it. So, and when we talk about school, college, and grades, one thing that I've always heard is, my 3.1 from college is really worth like a 3.6 now because we've had what's called grade inflation. Now, we're not going to go down the grade inflation topic, but, I'd argue, for all these young people, they're bringing home their transcripts with 4.0s or whatever. Like, hey, maybe the courses are easier. I don't know. I'm
Is
certainly.
that 2.5% a year as well?
I think it is. I think it is.
Okay.
My son came home and his grades were better than mine, and he's like, yeah, it wasn't that hard. And I'm like, yeah, I've heard about this grade inflation thing. Next thing you know,
If
you
you
guys all have.
compound that 3.1, over we won't go down how many years it is, but if you compound that 3.1, I think you got him.
I think so too. So with that, Corey, I'll turn it over to you. And we need inflation hedging. See, that's a tie-in.
Yeah, well, hey, I actually want to hit one thing first.
Sure.
On that note, so you were looking at the market cap kind of performance of the United States economy, stock market perspective versus those other countries who have all underperformed the U.S., particularly so in the last decade. And there's also one other component, though, the GDP weighting. So kind of looking GDP perspective globally, the United States does make up just 26% of GDP. So, why would they have a higher market cap? One thing to think about is the margins of the businesses in the United States. Our tech giants are high margin, highly profitable companies. And most businesses historically have not been able to sustain high margins over time. Margins kind of erode as competition increases and things like that. So, each of these countries listed on these charts, they've got some tech exposure in their economy, but not to the degree the United States does. And I think that's where you see that premium come in. And quite frankly, that premium is probably justified. Okay, looking at inflation hedges. So, whether you're a worker or a retiree, inflation is something that you need to, at least have on your investing radar as you go year to year. And I like this question. This is Ben Carlson here from Ritholtz. Um, Someone mentioned, hey, will prices go down? And I know you and I have talked about inflation in a few different ways on the channel over time, but Ben Carlson looked at, okay, well, you know what? When did we have deflation in history? When was that and why? Well, you had deflation after the Great Depression, so that's
Hmm.
not good.
We
You
don't want
had,
that.
yeah, you don't want that. And that's really the theme for all of these, right? Is anytime we've had deflation, and recently the great financial crisis, it has been a result of an economic crisis and a severe economic slowdown. Not really good for anyone. Around this time, I was working some hours as a cashier, and I remember, in 2008, 2009, the coupon clipping was incredible. People would come in with books. I'm like, oh, is that, a book of Pokemon cards? No, it was not. It was just a whole portfolio of coupons, and people were so diligent because they had to be. They had to be. I haven't been stuck in line behind somebody with a big book of coupons in years, Mike, and that's just it's a sign of the times, right?
Oh,
But
I
back then,
think I think they started making us cash out ourselves, so we don't want to put all those coupons in. I don't know.
yeah, yeah. So how can you protect yourself against against potential future inflation? Well, a good job is number one. If you've got that, your market value should increase relative to inflation year to year over time. So that's an important component. But maybe you're retired, and maybe that's not an option. A fixed rate mortgage. Well, a fixed rate mortgage is amazing. There's people, many Americans sitting on either no mortgage right now or a 2-3% mortgage, which is a huge hedge against inflation. As your income goes up, that mortgage payment stays relatively the same, of course, relative to some property tax increases and things like that. But maybe you're retired and maybe you don't have a mortgage. Can you protect yourself against inflation? Well, the thing, the asset and real estate assets can help with this as well. But stocks for the long run. So I love this line right here. Over the past 100 years or so, the US stock market has beaten the inflation rate by nearly 7% per year. Also, dividends have grown more than 2% faster than the annual inflation rate. Inflation adjusted earnings growth has come in around 3% per year. So, why do stocks protect you against inflation for the long run? It's because these stocks, these companies have pricing power. And if they get subjected to inflationary pressures, they have the capacity to pass that on to consumers. We've all been punished by that at the grocery store at times, but we can benefit from it on the other side as shareholders. So, um, stocks for the long run, holding assets, bonds. If you were looking head on into a high inflationary environment, bonds are not going to protect you the same way. And in fact, if rates go up, the value of your bonds might actually go down. So you can be hurt there. Where bonds do help is in an economic crisis. If rates go to zero, bond values do balloon up. So that's a potential benefit there. But if you're just looking to protect against inflation, if you've got everything else covered, stocks for the long run is my personal, favorite.
Excellent. Thank you. Thank you so much. And yeah, inflation is very unfair. Call it a tax on everyone, but especially the least wealthy. So it is very something we obviously want the Fed to handle. In fact, just a quick note, we'll probably talk about tomorrow's show. The Fed has their meeting coming up where they're very likely to make another quarter point rate cut. I've seen the probability is in the 90s, although the percentage of people that think they should is it really in the 60s. So we're starting to get the point where maybe the Fed should slow down the easing cycle so inflation doesn't go out of control. So anyways, well, I'm sure we'll be talking about more about that later this week. Thanks, everybody. Have a good one. Bye.